everybody, my name's Allison Ostrander. I am the Director of Risk Tolerance here at Simpler Trading. And in today's video, I want to show you guys a setup I am watching on GILD. Now there are two different setups you could look to play here. One is shorter dated for this week and one is further out in time. So I'll walk through both of those. But there are both overall bullish setups. Now, recently, GILD has had a nice pullback with the market, right? As we've dropped back down, we have started to break below the 100-period simple, so do want to be a little bit mindful of that. But the trend itself on the moving averages is not bearish yet technically. The 10-period simple, the short dashed line, is below the 100, but the 30 is still above both. So this is more consolidation, and that makes sense with the Bollinger Bands flattening out, with the consolidating signal down here that's canceled the bearish one, and we are of course seeing a squeeze set up, and we are seeing ourselves at bearish exhaustion like we did back here. So typically when you have exhaustion levels, there's a good probability that you'll just consolidate, or in the case of bearish exhaustion, you'll get a bounce back to the upside. On the daily chart, we have a valid bullish divergent bar looking for a move back up to or above 104.66 before the end of the week is up. So that already gives us a high probability, 8.5 out of 10 times that usually gets the follow through. So pretty good follow through rate there. On top of that though, there's also a bullish divergent bar on the weekly chart, same follow through rate actually, 8.5 out of 10 times it gets the follow through. And for those of you unfamiliar with this indicator, basically the divergent bar indicator helps give you a higher probability of a potential higher high or lower low based on the signal that prints for the bar. So in this case, this is a bullish divergent bar. So we're looking for a possibility to get back up to the high of this bar, which is 107.56 by the end of this week. Usually 3 bars is the sweet spot. It doesn't always work out, so we need to, of course, be mindful of risk. But you know, like I said, 8.5 out of 10 times it works. So this one actually I don't think got the follow through within 3 bars, but the bearish divergent bar followed through with a lower low. This one did here. Bullish divergent bar got the higher high. That one got the higher high. That one certainly got the higher high within 3 bars. I think it happened by the next one actually. This one had the higher high, and so on and so forth. So may or may not work out, but I do like the fact that it's done a good job of holding the 30. We also have recent weekly true lows. The last time we had true lows back here, that was a really good discount buy to jump in at to play for a longer term bullish run. Momentum on the weekly charts had a good reset, and we're attempting to cancel out the pullback signal. So for a short dated trade, if I was to do something this week on it based on that daily bullish divergent bar and this weekly one, as well as the overall weekly bullish strength, I would probably lean towards something like this. Now you could just go with a long call if you want to, so don't let me stop you. Gilead's rather inexpensive. But for those of you looking to define your risk even more, keep it on the smaller side, especially with, you know, it already being Tuesday going into the end of the week, I'd probably lean towards something like the 104, 107 vertical spread. It's about a 3-point width vertical. It's 71 cents. Has a 229 profit potential. And so the idea behind this is if the daily divergent bar at the very least follows through up to 104.66, you're partially in the money on this. You're, from an intrinsic point of view, right around a scratch, right? So ideally that helps you out. If you can reach the weekly target though of 107.56, then this spread is completely in the money, and that of course should allow for a very nice profit potential versus the risk. So that's something I would consider a bit more shorter dated for this week. Otherwise, as I mentioned, do like the overall pullback here. I like the recent true lows, the reset of momentum. So I think this might be a good place to buy, at least to get back up towards 120, if not potentially for a trend move higher. And to help with that added scenario is the monthly chart. The monthly chart has a squeeze firing. We made true lows basically all throughout this consolidated range since, I don't know, 2017 basically. And now it seems like we're finally attempting a move to the upside. Do want to be mindful of the prior highs around 120, right? So that could still act as a slight price resistance there. But momentum's headed on the right path, has plenty of room to move higher. This is still technically a valid bullish signal. And then of course we have a bullish divergent bar on the monthly chart, also has a good follow through rate. And this high is looking to get back to or above 114.75. So if you like the idea of how the weekly chart looks, but you don't want to do something short dated, you want to give yourself time, then I would actually go out to the July monthly expiration and do something like the 110, 115 vertical. Now, once again, if you want to just go with a long call, please don't let me stop you. 66 days is plenty of time to try and have that work out. But I focus on small accounts over in the small lots trading room, where I trade with Mr. John Carter on growing specifically small accounts and keeping the risk on the smaller size there. So, being mindful of that, I would consider doing the 110, 115. It's only about $1.21 right now, so certainly not a bad cost basis. If we get the follow through by expiration, you're $4.75 in the money from an intrinsic value and should allow for a nice profit based on the current risk that the mid is showing us. Even if you got filled at the bid, at the ask, right? That should still be a decent profit if you can reach that target. So that's, what I would be leaning for. The one thing I do want to point out on this, though, is usually divergent bars, I give 3 bars to try and work out. And just so you guys can see, right, great follow through on the last bullish divergent bar we had on the monthly. This one technically got a higher high within the next 3 bars. That one did as well. So did that one. That one barely did, but it did. This one took 2 bars to get the follow through, but it happened. But the sweet spot is usually 3 bars. So the downside on the expiration choice at this point is it's a little shy of the 3 bar rule. The reason why is on the monthly time frame, the bars print at the end of the month, right? Whereas monthly expiration is usually 3/4 of the way through the month. So here, for example, July 18th is what we have, but the end of month, sorry, let me try and pull up the calendar on the screen so you guys can see it. There we go. But the end of July, so there's the monthly expiration. The end of July is actually 2 weeks out. So if you wanted to give yourself the proper amount of time, you could push the trade out into August. And actually, looking at it now, that doesn't really cost much more. So I'd probably lean towards doing that. You're adding about roughly 18 more cents of risk to the trade, but you give yourself the full amount of time and then some to try and have it work out. And keeping it as a vertical spread, of course, or if you decide to do it as a long call or something, should, keep it to where if you do get the bounce and let's say all of a sudden we're there tomorrow because some good news comes out, this should still work out to a nice profit even with as much time as there is on the trade. So I kind of like that. And that is what I would lean towards for a longer dated trade idea. So thank you guys so much for joining me. As always, may the trade be with you, my fellow Jedis, and I look forward to talking to you next time. Bye.